It was. And what the beautiful part of it is how perverse the markets can be, because what happened was we were in October, and by the time we got to the end of October, nobody believed in seasonality. Nobody believed in November or December seasonality. Nobody believed that this market could actually enjoy an important rally. And then on November 1st, almost like clockwork, we get the Treasury announcement, which was positive for the markets in terms of funding needs, a little bit lower. And then the Fed at that afternoon meeting, right after the Treasury announcement, for the market interpreting it as a dovish pivot, that they're finished. Then added to all of this is the most important narrative, and that is that the market is convinced that the Fed is going to cut rates even as early as March. This part of that narrative is, I think, completely what the market is focused on. However, when we see these yields coming down, we always look at the pace of a direction, how quick or how slow. It has been very fast, coming from 5% on October 19th all the way down to today. It's been very quick. How about that? It is screaming a difficult economy, a difficult backdrop, perhaps a cry for help from the Federal Reserve, which is sticking to its narrative. No, we're not going to cut rates. The market is saying you're wrong, and you know it. And so it's going to be interesting to see what the Fed has to say next week.
Well, we have, before we get to next week, a big week of economic data culminating with the jobs report. Yeah. And we have very disparate signals coming through. Is the data bad enough to warrant some of what we're seeing in interest rate swaps, the Fed cuts next year, or are investors getting ahead of themselves?
Well, they're probably getting ahead of themselves. But again, when you look at the Treasury market and you see the rates coming down that quickly, it typically is underpinned by a growth scare. I mean, you don't usually see rates coming down that quickly. When rates moved up dramatically to 5%, Chairman Janet Yellen said, well, the term premium, it is based on the fact that the economy is so strong. Well, now that we're going in the other direction, Dr. Yellen, I wonder what she has to say now about how strong the backdrop is.
Wait, hold up, though. Going in the other direction, we saw, wasn't third quarter GDP 5.2% annualized? Are we truly going in the other direction?
Well, right now, the same forecaster, the Atlanta Fed GDP now, that had it almost nailed at 5.1, 5.2% for the third quarter, is looking at 1.3% right now. Of course, Friday is going to make an important difference in terms of what it has for December. But the fact is, it's not a recession. It may not be stellar, but it's not a recession. But again, this persistence of the market saying the Fed is going to cut rates, it doesn't end. In fact, if anything, it's been intensifying.
All right, so Quincy, it's December. It's time to start looking towards the year ahead here. What are you telling your clients about 2024?
Well, our view is that, first of all, to end this year, we like the fact that we're seeing some consolidation, even though it's this meandering between positive and negative territory. It's moving sideways. That's pretty healthy. It should lead us to a rally toward the end of the year. However, we don't want it to be completely overbought going into next year, because that sets the stage for more of a market pulling back. As the market figures out, how is the economy growing? Is it slowing too much? At this stage, it's still a question mark. We're still in positive territory in terms of GDP forecasts. So we're looking at quality. Actually, we're looking at large cap growth. And we think that is the place to be, particularly if you're in companies that have strong balance sheets. That's how we're looking at the beginning of next year. We do think a recession may hit. It could be a technical recession, just as we had over a year ago. But the fact is, we do see a slowdown and then a move climb higher. Remember, though, the market is a discounting mechanism. It looks ahead, months ahead. And that's why sometimes the market at this stage looks as if it's not in sync with what the Treasury market is doing.